Hey everyone, and welcome back to the channel. If you're looking to level up your trading game, you've come to the right place. Today, we're diving deep into the three fundamental pillars of trading strategies: trend following, mean reversion, and breakout trading. By the end of this video, you'll have a crystal clear understanding of how each one works, when to use it, and which one might be the best fit for your personality. So, grab a notepad, and let's get started. First up, let's talk about the classic, trend following. The philosophy here is simple and powerful. The trend is your friend. This strategy is all about identifying a clear, established direction in the market, either up or down, and riding that wave for as long as possible. A trend follower, in trying to predict tops or bottoms. Instead, they wait for the market to show its hand and then jump on board. So, how do you spot a trend? Visually, an uptrend is a series of higher highs and higher lows. Think of it like climbing a staircase. A downtrend is the opposite, a series of lower highs and lower lows, like walking down that same staircase. To confirm these trends, traders often use tools like moving averages. For example, if the price is consistently staying above a 50-day or 200-day moving average, it's a strong sign of an uptrend. When the 50-day moving average crosses above the 200-day, that's called a golden cross, a classic bullish signal. Conversely, a death cross, when the 50-day crosses below the 200-day, signals a potential downtrend. The beauty of trend following is that when you catch a strong, sustained trend, your profits can be substantial. The key is discipline. You need the patience to let your profits run and not get scared out of a good position by minor pullbacks. However, the biggest challenge for trend followers is choppy, sideways markets. When there's no clear direction, this strategy can lead to a series of small, frustrating losses. It requires a strong mindset to stick with your system, knowing that one big winning trade can make up for many small losses. So, if you're patient, disciplined, and comfortable with holding positions for weeks or even months, trend following might be your perfect match. Now, let's flip the script and talk about our second strategy, mean reversion. While trend followers say the trend is your friend, mean reversion traders say, what goes up must come down, and vice versa. This strategy is built on the statistical concept that prices, and many other things in finance, tend to revert to their historical average or mean over time. Think of it like a rubber band. The more you stretch it away from its resting position, the stronger the force pulling it back. Mean reversion traders are essentially bargain hunters or contrarians. They look for assets that have become overextended, either way overpriced, overbought, or way underpriced, oversold, and bet on a return to normalcy. They are buying when everyone else is panicking and selling when everyone else is euphoric and buying. To identify these overextended conditions, traders use indicators called oscillators, like the Relative Strength Index, or RSI, and Bollinger Bands. The RSI measures the speed and change of price movements on a scale of 0 to 100. A reading above 70 is typically considered overbought, suggesting the price might be due for a pullback. A reading below 30 is considered oversold, suggesting a potential bounce. Bollinger Bands consist of a moving average with two standard deviation bands plotted above and below it. When the price touches or moves outside the upper band, it might be overbought. When it touches the lower band, it could be oversold. Mean reversion works best in markets that are range-bound or choppy, exactly the kind of markets where trend followers struggle. It offers a higher frequency of trading opportunities. However, the danger is significant. You are, by definition, trading against the prevailing momentum. What looks like an overextended price could be the beginning of a powerful new trend. Catching a falling knife, buying into an asset that just keeps dropping, can lead to major losses. This strategy requires precise timing, excellent risk management, and the nerve to go against the crowd. If you're a quick thinker who loves finding value and can handle the pressure of counter-trend trading, mean reversion could be your calling. Finally, let's talk about the explosive one, breakout trading. This strategy is all about anticipation and action. Breakout traders watch for periods of consolidation, where a price is trading within a tight, well-defined range, often called a base or consolidation pattern. This range is defined by a level of support, a price floor, and a level of resistance, a price ceiling. The idea is that this coiling price action is building up energy, like a compressed spring. When the price finally breaks out of this range, it's expected to move powerfully in the direction of the breakout. Breakout traders are looking for that exact moment when the price decisively moves above resistance or below support, usually accompanied by a significant increase in trading volume. That volume is key. It confirms conviction behind the move. Common patterns that breakout traders watch for include triangles, rectangles, and flags. Once the breakout occurs, the trader enters a position, hoping to ride the initial burst of momentum. For example, if a stock has been stuck below $100 for months and suddenly closes at $100 on high volume, a breakout trader would buy, setting their stop loss just below the old resistance level of $100. The great thing about breakout trading is that it can lead to very quick, powerful profits. It's an exciting way to trade, capturing the start of a new trend. The biggest challenge: false breakouts or fakeouts. This is when the price breaks out of the range, tricking you into a trade, only to quickly reverse and move back inside the range, stopping you out for a loss. It happens all the time. To succeed with breakout trading, you need to be decisive, have a plan for managing false breakouts, and act quickly when a valid signal appears. If you thrive on action and can make quick, calculated decisions, breakout trading could be incredibly rewarding. So, there you have it, the big three: trend following, about riding established waves of momentum; mean reversion, about betting on a return to the average from extremes; and breakout trading, about capturing the explosive move out of a consolidation. Which one is best? There's no single answer. The best strategy is the one that aligns with your personality, risk tolerance, and the current market conditions. Many successful traders even combine elements of all three. For example, they might use a trend-following approach on a daily chart, but look for mean reversion entries on an hourly chart within that larger trend. The most important thing is to pick one, study it, practice it with a small account or in a simulator, and master it. Don't jump from one strategy to another after a few losing trades. Consistency is the key to long-term success in the markets. Trading is a journey of continuous learning, so be patient with yourself. I hope this breakdown was helpful and gave you a solid foundation for understanding these core strategies. If you got value from this video, please hit that like button. It really helps the channel out. And if you want more content like this to help you become a smarter, more confident trader, make sure to subscribe and ring that notification bell so you never miss an update. What's your favorite strategy? Or which one are you most excited to try? Let me know in the comments below. Thanks for watching, and I'll see you in the next video. Trade safe.